The daily edition of Market Wrap with Mo Ansari.
Brought to you by Compact Asset Management.
Providing proactive portfolio management and world-class wealth management solutions.
Hello, everyone, and welcome to Market Wrap. I'm Mo Ansari, president of Compact Asset Management, and you're tuned in as you've been doing so for 2 decades now. And as always, you can call in, and I will be more than happy to share with you my 33 years of trading experience. We are going to go to our guest line, and today we have Mr. Bob Carlson. He's editor of the monthly newsletter Retirement Watch. In his newsletter, Mr. Carlson provides independent, objective research covering all the financial issues of retirement and retirement planning. Since 1992, Mr. Carlson has served on the board of trustees of the Fairfax County Employees Retirement System, which has over $2.8 billion in assets, and is currently the chairman of the board of that particular organization. Mr. Carlson, welcome to Market Wrap.
Thank you. I'm glad to be here.
Bob, let's talk a little bit about your, you have 2 parts of your newsletter, and one is more market-related, one is more retirement-related. Let's start with the market-related issue, and I'm looking at the headline. It says, Rediscovering Risk as Momentum Falters. Do you think the momentum in this market is faltering right now?
I think it is. I think the market's had very powerful positive momentum since about March of 2009, and that was spurred largely by a lot of stimulus from the government and the Federal Reserve. That stimulus has all been being withdrawn, or it's having less effect, and that's affected the market. The momentum has definitely turned negative, and I don't see that there's a lot out there that's going to find some way to turn the positive momentum back on anytime soon.
So this bull market, as it was called since March of 2009, is coming to an end. Is that what you're saying at this time?
Well, my belief is this has been a bull rally within a long-term bear market. I think we're still in the long-term bear market, and I think that's going to continue until the level of debt in the economy that's held by both individuals and by the government is reduced to a more reasonable level. People are deleveraging, they're reducing debt, which means they're also reducing spending.
What gave you the indication that we are starting this long-term, this rollover and losing momentum?
Well, I've been anticipating a long-term bear market since the late 1990s, and I think the reason, or what made me think this current rally has lost its momentum is I look a lot at moving averages, both the 50-day and the 200-day moving averages, as a sign of the momentum.
Let's move over a little bit and talk a little bit more about Retirement Watch, the other part of your newsletter. A lot of we take a look at that, and we often talk about the importance of estate planning and assuming that everything is in order for most of our clients, or we try to get that they should have a will, they should have a trust, they should have the durable medical directives at least. But there's some things that they need to be aware of as well. In a recent article on your website, what heirs should know about IRAs, you explained that some of the biggest mistakes with IRAs are made after they pass to the second generation. Tell us a little bit about what is this mistake and how can it be avoided?
Well, there's several mistakes people make. A lot of people don't realize that, for example, the first thing they don't realize is when they withdraw money from an inherited IRA, it's included in their gross income, just as it would have been for the prior owner. So they're taxed on it at their regular tax rate.
Right.
So that's the main thing a lot of people forget. They think they can just inherit an IRA, take all the money out. Another thing people forget or don't know is if they don't want to spend the money, they are entitled to let that deferral continue for the most part, but they have to make required minimum distributions each year.
Right. Which would be very small amounts of money that they have to take out, the required distributions, or do they have to take out the same distributions that were coming out previously?
All right. When someone inherits an IRA, they can have it distributed over their life expectancy. The IRS has some tables in publication 590 that lists the life expectancies you have to use.
Right.
So if someone young, say a grandchild, is the beneficiary of an IRA today, they're going to have a very long life expectancy, so the required annual distributions are going to be quite small.
Mr. Carlson, another big issue right now is to convert or not to convert. And I mean the Roth IRA to a Roth IRA. And there are huge considerations with respect to retirement planning. But the big question is, pay the taxes now, or should we pay the taxes later? Most of the people that come to us, their accountants, are just trying to defer taxes, defer taxes, defer taxes. All of a sudden, they've created a huge tax bubble that is going to explode on these people somewhere down the road. And that's something that people are not aware of. All they want to do is not pay taxes now, but they don't realize that they will have to pay taxes somewhere down the road, and that could become a big bubble of tax that could hit them. Is that something that can happen to people and something that people should be aware of?
Absolutely. The time-honored tax planning strategy has been to defer taxes whenever possible. Keep that money as long as you can. But people should reconsider that strategy now for a couple reasons. One is we have all these income tax increases that are automatically scheduled to come into play beginning 2011 and beyond that. In addition, the deficit has grown tremendously, so there's likely to be even more tax increases on at least a number of people, and a number of states also are increasing their income taxes. So it's not a simple matter, as it was in the past, of deferring taxes and paying the same rate at some point in the future. Now, if you defer taxes, you'll have the money to hold on for a while, but when you finally pay those taxes, it's going to be at a higher rate, and it might be a substantially higher rate. So you could really be hurting yourself by paying taxes later instead of paying them now.
So it does make sense to sort of balance this out and not get too one-sided as far as taxation is concerned, to try to defer, and all of a sudden you have a bubble that can hit you. What about some of the other things that people need to be aware of as far as estate planning goes? How important is it to work with the second generation? And we do some what we call legacy planning or legacy seminars, where we work with the second generation and try to educate them on what they might be inheriting and how they should manage it and so on. Is that important for the first and second generation to communicate? Or is it sometimes you see parents, they don't want to tell the kids anything about their financial situation. All of a sudden the kids end up with a whole bunch of money when the parents passed away and they have no idea what to do with it. What do you think is the communication? What is the right amount of communication between the first and the second generation?
Yeah, the coordination between the generations is really important. What we see a lot of times is the first generation will put a lot of time and effort into the estate plan, and they'll just be making assumptions about the following generation. And it'll turn out those assumptions are not true. Either the kids had different goals and intentions than the first generation thought, or they just do not have the financial knowledge or financial skill that the parents just assumed they had. So those are very important. And a lot of times kids will inherit property or a business or something, and they just won't know much about it. They won't know why the parents owned it in the first place or what their goals were for it. And the parents actually had a fairly clear plan of how to manage this property, how to make it grow, but they didn't communicate this well to the kids. They just thought the kids would absorb this from them somehow, and they didn't. And so the kids will either sell the property for less than they could have, or they'll just mismanage it. So the communications is very important, and the real trick is, if some parents don't want to communicate directly with their kids, what they can do is just have their own financial advisors meet with the kids, discuss things with them, and pass information along. So that way, a lot of times the discussions can be more candid, because the emotions between the parents and the kids don't come into play, and instead you have the professional advisor passing along the information.
Mr. Carlson, I want to thank you for taking the time out of your schedule today and being with us today and sharing your thoughts with us on retirement and what some of the people should be aware of as they do their retirement planning. Thank you again for being with us today on Market Wrap.
Well, thank you for having me.